Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The key recent pattern here has once again been the ascending triangle formed over late June through to late July. That also could be counted on the continuation charts that I use as a triple top. The ascending triangle is highlighted in dark blue on my daily chart. The break lower in late July saw a move down to the primary target of 1364 with some ease in just over a week. The harder to reach secondary target X in the 1278 zone, well, that has been harder to reach. Prices followed on low from the break in August, but by mid-August they had formed a pipe bottom and risen back up. On the face of this, having less of a low than in May would usually indicate a market that is heading higher. However, not so, or at least not so far in this market. You see, prices did try and rise, but ran into overhead resistances between that long-favoured congestion, the base of the late 2022 descending triangle at 1378. And the lesser Fibonacci line at 1409. We also had in that area other congestion at 1386 and 1400, plus the then declining medium moving average currently at 1366, and short medium moving average currently at 1384. It's seen much as I said 6 weeks ago, and I quote, "Overall, the picture is thus. We now have the short medium and medium moving averages as overhead resistances, plus the combination of the base of the late 2022 descending triangle plus the lesser Fibonacci line, both at 1378. This left the door open, that's the end of the quote, this left the door open to try and make it down to target X at 1278. However, I did lay out an alternative 9 weeks ago, which still needs to be considered, and I quote, it was to look at the whole mid-March day action as a possible very large reverse head and shoulders pattern. It is still too early on this one to verify such a pattern, but is worth considering, though the one key point against it is location of this pattern. It does not look close to a bottom, as the November 2021 low and the 2021 low overall indeed is lower. However, I would keep an eye on this idea in the back of your mind just in case, and that's the end of the quote. I would continue to keep this idea in the back of your mind just in case, even if target X is reached, as a lot will depend on what the market will do there, should of course it reach down that far. The one new item I would add is that I have drawn a late July to mid-August bearish shift pitchfork, highlighted in purple on my daily chart. The current market is in between the middle time below, currently at 1220, and the upper time above, currently at 1354. The market had breached the upper time a week ago, but did not break it. And from my point of view, it is starting to show a pretty good idea of the current bearish angle of attack of this market. Chicago soybean meal. The recent key pattern here, much as in the case of soybeans, has been the mid-June to early August ascending triangle, which is highlighted in bright red on my daily chart. This is on top of the longer-term May 2022 to date broken, then repaired, then broken again, then desperately repaired again, and now broken yet again, ascending, expanding wedge pattern. This is a huge pattern that I pointed out many, many months ago. It was never a perfect pattern by any means, but it finally started working in late May this year. To assist you in seeing this pattern, I've highlighted it on my daily chart in dark blue. However, the upper trend line has exited top left, though the lower trend line, currently at 432.80, is still here and has been very relevant to the current market, as also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. The original break low of this past May, below this trend line and neckline combination, indicated a potential primary target that is still well off the bottom of my daily chart at the incredible 324 zone, and a secondary hard to reach, much harder to reach target in the 283 zone. These are the ones you can make a note in your diary and maybe look at once or twice a year. Moving now to the more recent pattern, one I highlighted 9 weeks ago, and I quote, "This action since mid or even late June has a strong possibility of being an ascending triangle, such that I would watch carefully any moves lower just in case," end of quote. Well, 8 weeks ago I formalized this pattern, which is, as I've already mentioned, and is highlighted in bright red on my daily chart. 8 weeks ago also we had a false break on the upside with what turned out in the end to be a 3-day bearish evening star pattern that eventually led to the breakdown out and below the bottom of the ascending triangle. 6 weeks ago I gave potentials below for this pattern. Primary target 408.60 and a hard to reach secondary target X1 at 381.40. Changeover easily saw the primary target reached, and we even came awfully close to target X1, but we did not reach it as prices pulled back up. However, the pullback up ran into traffic overhead from the then rising short medium moving average, currently at 411.20, and perhaps the more important, declining medium moving average, currently at 409.30. Enough that we saw a 3-day bearish evening star pattern, and from which we saw the recent declines. This prompts me to still leave target X1 open and live, and to see if prices do struggle back down to the sub 390 level. The one new feature I've added since last time has been a late July to late August bearish shift pitchfork, highlighted in purple on my daily chart. The market is currently in between the middle tine below, currently at 377.40, and the upper tine above, currently at 401.70. So far, this pitchfork has done an admirable job of showing the bearish angle of attack of this market, and I would keep a close eye on it going forward. Finally, this brings me once again to my final point, which I raised 16 weeks ago, and which I will keep raising for the rest of this year, at the very least. You see, on my long-term monthly charts with nearly 3/4 of the year gone, 2023 is set to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve, either above 471 even or under 399.10, then we'd be on. Anything in between would have a lesser outside year. Right now we are looking at a possible annual key reversal down, but we still have so many months still to go. Chicago soybean oil. A new pattern has taken its place as the key pattern here, rather than the previous and somewhat dated late November 2022 to early June 2023 descending wedge pattern. The new pattern is the late June to mid-August head and shoulders top. You can see the neckline highlighted in dark blue, currently at 65.03 on my daily chart. But I've also seen the construction of a handle or extension onto this head and shoulders pattern throughout August that only started to fail as we entered September. The potentials for this pattern were a primary target in the 60.38 zone, a secondary hard to reach target X down in the 56.74 zone. The initial fall was in a fairly free area once prices got past the short medium moving average, currently at 63.96, and the 2011 high at 61 even. Thus the primary target was easily reached just after a week. However, prices have started to hit support below that original support at 59.54 is where we've seen it. This support stretches down quite a way, down to the 50% Fibonacci line of the March 2020 to April 2022 move at 56.34. The significant levels within that congestion are the long moving average, currently at 59.14, the medium moving average, currently 58.98, the August 2011 high at 58.59, the recent late May to late July 50% Fibonacci line at 56.91, and of course the secondary target X for the head and shoulders top, down in the 56.74 zone. I am cognizant that we are pressing through some of these, but I wanted to put them out to you. What is interesting about all of this is there is still the possibility of the medium moving average and the long moving average forming a golden cross. It's still early, but it's something to look out for. Finally, something I mentioned 12 weeks ago and ever since, and I quote, I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern. End of quote. Now, I'm not going to expand any further on this idea at this time, as it's still early on, but the recent market decline fits in with this idea, though the expectation would be to eventually witness a fall down to the area of the May and June lows, which is a little hard to see right now. However, I do wish you, and also me, to just keep this in mind, especially as such recent action as we have seen, and also the head and shoulders action, well, they fall well into such a pattern idea.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.